I got multiple prop firm payouts, and I've helped several students accomplish over 6 figures in profits. If you're struggling and you trade Forex, hear me out. In this video, I'm going to give you 5 reasons why Forex trading is harder than futures and stocks, even though there are outliers who trade them profitably. If you look around online, you'll see clues from pros that talk about how hard Forex is, but due to the low barrier of entry and the marketing, the huge marketing ecosystem, many beginners are drawn to Forex, not knowing that there are better markets to be trading. By the end of this video, you'll have a comparison between Forex, futures, and stocks so that you can choose which market may be better for you. There are pros and cons of each, but there's one market that I believe is easier to trade and offers more opportunity for both scalpers and swing traders. So Forex is not necessarily a scam. I've traded Forex for years. I would draw supply and demand zones. I wait for the perfect setup, and I had to move away from currency pairs and move into indices and commodities because I wouldn't have a lot of setups. And I thought the problem was me, but I learned years ago that the problem was the market that I was trading. I was sitting at dinner with the mentor of one of the market wizards, and he's raised 7 and 8 figure traders. And I asked him why they don't trade Forex in the firm. And he says, one of my 8 figure traders, a guy that does 8 figures every year, if he traded Forex solely, he would be unprofitable, because the reality is with Forex, there's a lot of market noise. And I know there's influencers out there who are showing you payouts, who are showing you profits on the screen day in and day out, especially in developing countries. But a lot of this is unverified. The prop industry has made it easy for people to blow accounts and show you the payouts. You don't know how much money they've actually made. So when I switched to stocks, everything else clicked. It was all like a connected story. The price, the volume, the news, and the order flow all connected. So if you ever wondered why Forex feels like you make some money one month and then you give it right back, while you see verified stock traders printing money with clear setups, listen closely. Here are the 5 reasons why I quit for good. Now, number 1, okay, the very first reason, and the most important, you're not gonna hear this in any of the comparison videos. The retail FX trader normally is trading noise, what's called market noise. There's a guy who claims to have coded the algorithm that many of these traders use to trade FX, but they're just trading noise. That's why the strategies lose edge so often, because it's market noise. Market noise is essentially tiny fluctuations caused by small traders that are buying and selling for random reasons, algos that are buying and selling, temporary reactions, and just short-term liquidity imbalances. So these moves oftentimes look chaotic, and they don't represent real information about the direction, right? So it's hard for traders to consistently beat the market by trading market noise. So there's a book that many retail traders have never read, don't know about. There's a book called The Random Walk on Wall Street. Many of the professional traders know about this book. And he argues that that market noise, or this little short-term price movements that are a collection of random trades, they don't reflect meaningful information and cannot be relied on to predict future prices. So if you feel like you're jumping from one strategy to another, you could potentially be trading market noise and essentially be capped by what's called the random walk hypothesis. So the price changes, they behave like a random walk, meaning that the past price movements do not reliably predict the future market movements. So the market is not totally market noise, right? So let's look at Euro USD. So Euro USD, many traders would sit here for this 7 days, okay? And these movements here up and down, they'd sit here and blow up money here, trying to use some strategy that is given to predict price movements in the range here. And for some, it may even work for a month or so, but it's hard to carry out a strategy like this over time and consistently beat this because, again, there's algos that are trading here. There are small traders here. There's not enough useful information here that you can rely on consistently. And that's why something like Forex here may be hard. So now what's happening here as Euro USD breaks out of that consolidation and gives a trend? This is typically caused by some sort of catalyst, okay? It can be interest rate changes, CPI, central bank policies. It could be something happening with the US dollar, where the US dollar is rising and causing this comparison between the two to fall using their relative strength analysis. What professional traders trade is not noise. They are trading movements that happen from real events. So essentially, a stock trader, if they were forced to trade Forex, they would be looking for a predictable reason why something like Euro USD would break out of the range. Okay, an event. They'd be looking for an event. So professionals trade based on events that happen, right? So this could be earnings, contracts, FDA approvals, mergers and acquisitions, government policy changes, and then that event normally causes a change in the following: price, volume, and order flow. And the reaction is very tangible and reproducible, right? So it's the difference between predicting noise versus tracking cause and effect. For the gold traders know this by, if they look at how gold has run up, and there's a real catalyst that is supporting the move here, okay? And that just recently topped out, okay? But day in and day out, stock traders are looking for a catalyst or an event. So if you look at RGTI, this is a stock, quantum computing stock. Price was in this range here. So stocks will trade with noise, but when this price moves out here of the range, there's a catalyst, there's an event that causes this stock to run for multiple weeks. So there's an event. And then what we'll see something that we can't, that's not useful in the Forex space is volume. So if you look at the volume here, when price was in the range here, you're gonna see the volume is trading around the average. But once price breaks out, we're gonna see the volume start to spike, and it starts to increase as RGTI starts to move higher and higher. So not only do we have an event that triggers price breakout, then we have the volume that reinforces the idea, okay? And then if you want to get even more granular, as a scalper, the order flow, we can see the institutional buyers and sellers. We can see who is more aggressive. So that's a big difference there. Number two, now if we were to take the event-based style that professionals use, the problem is that Forex pairs move based on a broad catalyst. We have to wait for the world to move, meaning economy, interest rates, central banks, they move the Forex pairs. Normally, indices even and currencies can chop sideways for weeks on weeks on weeks without a macro catalyst hitting. For example, we look at Euro USD again here on the daily. There's these periods where look at this slow grind here. It's 37 days of no clear direction. Even if you look, this stock is up and down here for 118 days. Okay. And some of y'all may say, well, what about the 1 minute? That's the daily. If you look at the 1 minute time frame compared to stocks, you'll see that there's a lot of chop here on the 1 minute versus a stock that trades very cleanly. Okay. So if you look at a stock, you see a move like this happening every day. This is the 1 minute time frame. Look at how clean this is. Price spikes up, consolidates, and then blasts up to the upside, right? So these are the types of moves on stocks that are happening every day, very clean catalyst. And then we have price action and volume is going to react. Stocks are moving based off of narrow events, very focused events. News comes out about the stock, and you don't have to wait on the overall economy or a macro event, a large event. There are hundreds of independent catalysts daily, each of them offering chance for edge. So you can isolate one ticker, one story, one move, and repeat that process. So the game becomes, let's find the stock that's a gainer. Let's see if there is significant news. Let's see the volume start to spike. Let's look at the price action. Let's read the tape and let's get an entry. And that becomes the game every day. It's clarity. This is the clarity that most of you all are missing. So share this with someone if they've been struggling with Forex. Now, number 3, if you ever wonder why the majority of prop firms are Forex and futures instead of stocks, it's because they know the odds. So prop firms promote Forex because it's harder for traders to stay funded. They promote futures. It's harder for traders to stay funded. So they profit from the resets, not your payouts. And Forex gives them higher failure rates, and it's easier to manipulate. So they truly wanted to succeed, they'd offer you access to US equities. This is why the average eval firm is trading futures and Forex versus a traditional firm that wins when you win. They are primarily trading equities. Look up the big firms, S&B Capital, Trillium. All of these firms are trading equities. So after just taking a step back and looking at the industry, all these guys that have relationships with the brokers, they have their own broker, they're faking all of these accounts, and they get you into their broker, and you know what's happening? You're not trading in the real market. You're trading in a simulation. What do you mean by that? The Forex market is decentralized. So all of the brokers are basically, when you enter into with a broker, they all are offering you their own prices and whatever volume they want to display. So that's why you have different prices, different volume, and no access to order flow. While with equities, you have one centralized market. So everybody from around the world, I'm in the US, I'm in the UK, I'm in Sweden, wherever I'm trading from, Dubai, everybody is trading on a centralized exchange. So the price is the same everywhere. The volume is the same, and you can see the order flow, minus the dark pools that I know someone's going to say that. But there's enough volume that's traded out in the open for you to get a sense of of who's more aggressive, and for you to see the passive buyers and sellers. So the brokers on the equity side, they prefer you to win, because as long as you have an account with them, you'll be paying commissions in most cases. Okay. So my broker right now, my stock broker, I can call them, they'll answer, because they want to make sure that I have the best execution. They give me the best platforms. They give me the best service, because the longer I trade, the more I pay commissions to them, and they'll stay in business this way. So oftentimes for the best brokers, they want to partner with profitable traders who are going to bring more profitable traders. This is just what they say, right? So, hey, they'll partner with me, and their pitch is not, hey, let's get a bunch of people on this platform and continue to bring people in. And if they lose, we're going to split the profits, or we're going to get paid from their losses, or we're going to pay out the good traders with the money that we make from the failed resets. No, let's bring profitable traders in, and we want them to trade the market longer, because if they are trading the market for 5, 10, 15, 20 years, making profits and paying us commissions, we're in business longer. There's a big trader last year. He showed me he paid $250,000 in commissions to a broker, one person. Incredible. All right, number 4 is more opportunity. When Forex traders are waiting for volatility, let's say we go back to this range of 37 days where people are complaining, oh, the market is garbage. They're waiting on volatility. Stock traders are getting paid. Why? Because there are thousands of tickers, and something is almost always hot. Low floats, mid floats, sympathy plays, earnings, different sectors. So while one trader is getting chopped because they're limited by the market that they trade, the traders in the stock market are filtering, scanning, and picking the best movers every day instead of forcing trades and giving money back. So more tickers, more setups, more consistency. Also, a big day in Forex is 1%. Okay, so this big giant candle is about 1.6%. A slow day in stocks can be 20%, 10 to 20%. Okay, so the range of move and the amount of opportunities is just so much greater. Go back to the RGTI example. This one candle is 16%. So in a few days, this stock rose 56%. So while someone was waiting on Euro USD, this stock is running. And that's how stock traders consistently have opportunity day in and day out, even more swing opportunities, more swing trade opportunities in the stock market. Number 5, transparency. So FX is decentralized and the stock market is centralized, meaning different brokers have different prices, different volume, and different order flow. But the stock market has a centralized exchange. So same prices, visible volume data from all the transactions minus a small percentage, and visible prints on the time and sales order flow. So that transparency lets you confirm what's real, not just draw zones and hope. Once I started trading what I could see, my win rate increased, I had more opportunity, and I was more consistent, and I could scale up with more confidence. So in stocks, every share traded is on record. You can see the buyers, you can see the sellers, you can see the speed, you can see who's more aggressive. And once I started trading what I could measure instead of market noise, everything changed. It wasn't about being smarter, it was about seeing clearer, more clarity. So those are the 5 reasons I quit Forex. If this has opened your eyes, share it with a trader who is still stuck in the prop firm hamster wheel. They deserve to know the truth before they waste another reset fee. If you want to see how I help students go from 0 to 100K, click the link in the right-hand corner.